Well, with two trading sessions left for the month, including today and Monday, let's get more perspective on the recent rally. Dan Greenhaus is the chief global strategist at BTIG, one of the largest trading firms on Wall Street, and he joins me here in studio. Dan, welcome to Bottom Line. Thanks for coming in.
Thank you, sir.
Some of the information I just read about the S&P, it's been an interesting last couple of weeks, but in July and August, the index fell by nearly 20%. What happened?
Well, I mean, it's not surprising to see that what's been leading us over the last couple of weeks, materials, energy, financials, were exactly the particular sectors that got hit on the way down, materials, energy, financials. And so I would just make a quick point. When you have people come on here and say financials leading the way up is a positive, it signifies growth concerns. If energy's out front, remind them that these were the sectors that got smashed just 2 months ago.
So the 20% decline, were there, if I'm not mistaken, from some of the information I was reading from you, you think there are two causes to this,
Sure.
right?
I mean, we had been arguing for some time that the 20% decline was predicated on the idea that the European Union or the euro area was breaking up and that the U.S. was in or imminently entering a recession. And we argued from 1100, the first time we touched it, that
Yes.
neither of those seemed to be coming true. And if that was the case, then at a minimum, the S&P belonged closer to 1,300 than 1,100. And I had numerous conversations with clients, and Bobby Parisi, who's one of the most, who handles some of the largest trades on our desk. Clients have been coming to us saying, why are the U.S. is in a recession? Look at the way the sentiment data is collapsing. And all that we were saying to our clients was the soft data was weakening, but the hard data, retail, what consumers were actually doing was holding up. And indeed, as we saw in the third quarter, consumers did quite fine.
We were talking about Europe, and yesterday, as you know, the markets did react positively to that news. But today, not so much. And we have a chart about the Euro plan and what they are trying to do, or at least trying to accomplish. The initial euphoria, it's now being tempered by some closer scrutiny that we have of exactly what the plans entail. Coming up with one plan is one thing, but implementing the plan is quite another. Talk to us about how the markets reacted to that yesterday and what they are saying today, why they took that breather.
Well, when you spoke to customers or clients of BTIGs who were paying pretty close attention to this, reading every FT and UK Telegraph article that was coming out, it really seemed as though sentiment was worsening, that the Germans and the French were moving further and further apart, that they couldn't really get their act together. And while there are a number of holes in the announcement, in the package announced just yesterday, not dissimilar to the July 21st package, considering that sentiment had worsened to a point where we thought that this whole thing was just going to fall apart at the last possible second. Remember, this was supposed to be decided by Sunday night. They needed until Wednesday night to get it done.
Yeah.
The fact that they didn't totally drop the ball was met positively by the markets. Now, we're going to have to revisit this over the coming weeks and
Absolutely.
quarters. But for now, you can breathe a bit of a sigh of relief.
Yesterday's global rally, was that a turning point? Can the focus now shift away from the Eurozone and back toward the U.S. economy with our housing problems and our 9% unemployment?
Yeah, I mean, this is the great irony that it's not as if you're turning away from problems in the Eurozone
Sure.
towards a robustly growing U.S. economy. The great irony is that the U.S. is mired in this muddle through economy, as John Malden has been saying for 10 years. And it's likely to continue for the next couple of quarters. And so what we've simply been arguing to people is, while we believe the equity market should be higher because we don't think the U.S. is in a recession.
You do think they're undervalued now?
Well, you can certainly make the case that they're undervalued, and we have been arguing that rather than at 1,100, we should be at 1,300. We take that in sort of a near-term cyclical view while reminding people that, in terms of growth expectations for next year, GDP at best is going to grow 2%. We actually think there's a pretty good likelihood of a U.S. recession, certainly a U.S. recession. Earnings growth for the S&P 500, I think earnings are still too high and they're going to have to come down. You're talking about low single-digit earning growth for the S&P and no chance of multiple expansion.
So even with the metrics that we're seeing now, there has been growth, but that growth is sluggish. But you're still betting on another recession next year. Why?
Well, I mean, there's a couple of reasons, and we probably don't have time to get into it. But
we will make time.
Well, great. This is wonderful for me. Listen, there are a couple of important points that I want to hit on. The first of which is, in these types of environments, these secular bear markets, let's call it, recessions happen more frequently. Expansions are shorter. So when you study, history going back, let's say 200 years, recessions happen every 3 to 4, maybe a little longer, 3 to 4 years, let's say. The last recession was in 08, 09, let's say. So you're coming up on 2012, 2013, where the chance of a recession historically becomes likely. Then you add in the fact that we have this myth in the United States that cutting government spending is going to immediately and sufficiently unleash the private sector. This is utterly false and has never been borne out in the history of the universe. The closest you can possibly come to it is Ireland in 1987. They sort of gave this a shot, and their growth rates afterwards were a little higher than the growth rates before. So what you're seeing in Europe across the entire region is basically they will be putting themselves into recession, and the correlation between growth in the United States and Europe has been rising as the Eurozone has matured, and add all this together and you have a somewhat likely chance of a U.S. recession.
Dan, let me just ask you quickly in about 30 seconds, late fall, early winter, that's usually the good time for equity, strongest period.
Sure.
Do you expect that to stay the same this time around?
Yeah, I mean, we've been operating under the assumption that the U.S. equity market, S&P 500, could get up into the 1325 range in the near term. You'll have to reassess things at that level, and you, of course, introduced the super committee in November and December, something that has gotten very little attention here in the U.S., but has the ability to absolutely explode the equity market to the downside.
Dan Greenhaus, Chief Global Strategist, BTIG, joining me on set. You mentioned before, first time we've actually gotten a chance to sit down and talk to each other.
Thank you for having me, sir.
Come back. This is fascinating.
My pleasure, sir.
Thanks so much.